Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 6th. The market's been quite blasé about the risk of Greece leaving the Eurozone after the coming election, but that risk came into focus yesterday after the German magazine Der Spiegel said that Chancellor Merkel is willing to accept Greece leaving if the new government in Athens demands concessions. Of course, the story was totally denied, but it did raise the risk level, especially because the Greek Prime Minister Samaras is trying to scare people into voting for his party by warning that a vote for the opposition Syriza party coalition would in fact mean leaving the euro. As a result, European stocks fell sharply while bond yields rose in both the peripheral countries and the core. That indicates capital flight from Europe. That's just a small indication of what might happen after the new government comes in. Actually, there's a growing concern now that no party will get a majority and that Greece will have a weak coalition government or even another election after this one, meaning that the uncertainty is bound to linger on. In short, the Greek crisis is likely to hurt sentiment towards the euro until and even after the election, in my humble opinion. Now, the dollar weakened yesterday nonetheless on what seems to have been just profit-taking on the recent swift move. I expect the dollar's weakness will only be temporary, though, and I think, if anything, it simply sets up more attractive entry levels for long dollar positions. Sterling was the exception among the G10 currencies as it weakened against the dollar following a disappointing construction sector PMI. But this construction sector PMI still signals strong expansion in the sector. With oil prices falling and inflation nearing zero, UK growth looks likely to continue robust, and I'd expect sterling to gain against the euro, although probably not against the dollar. Oil and other commodities were generally weaker yesterday, although the Aussie dollar and Kiwi both gained. I think the fall in all commodities bodes ill for them. Also, the drop in oil prices in particular is a bad sign for the Canadian dollar. As for today's highlights, during the European day, we get the final service sector PMIs for December from the countries we got the manufacturing data for last Friday. As usual, the final forecasts are the same as the initial estimates. The revisions in the final manufacturing PMIs on Friday increase the probability that we'd see downward revisions in the service sector PMIs as well. The UK service sector PMI is expected to have decreased slightly, which could be negative for sterling after Monday's disappointing construction PMI. In the US, we get the final market service sector PMI and the ISM non-manufacturing index, both for December. Factory orders for November are also coming out. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.